This might be the single most important question when it comes to the future of our economy, yet no one knows the answer to it. The question is, are high interest rates here to stay? If you've been keeping up with the financial media recently, you've probably seen all of the shock and all of the angst caused by what's going on in the US Treasury market. This month, the interest rate on the 10-year Treasury note, which is arguably the most important interest rate in the economy, surged to a 16-year high close to 5%. Now, this is different than the rate hikes by the Federal Reserve we've been hearing about over the past year and a half. This is a much bigger deal because it suggests that financial markets are starting to anticipate a world in which interest rates are much higher moving forward than they were over the past decade and a half. And if that's the case, then the entire economy may need to adjust to this new paradigm. That could have dramatic consequences for consumers, businesses, governments, house prices, stock prices, and more. I'm going to talk about what this might mean for the economy, but before I do, let's quickly go over how we got to this point so you have more context for what I'll talk about later. Let's start by rewinding the clock back to March 16th, 2022. That's the date on which the Fed hiked a key interest rate for the first time in 3 years in response to skyrocketing inflation. As you might know, the Fed conducts monetary policy by adjusting the Fed funds rate, which is the rate that banks pay to borrow money from each other for one night. The Fed uses the Fed funds rate as a tool to either slow down or speed up the economy. In this case, the Fed was trying to slow the economy down in an attempt to bring inflation down with it. So in the year and a half following that first rate hike, the Fed continued to lift the federal funds rate from an annual rate of close to 0 in March of 2022 to 5.5% this past July. A massive increase, the likes of which we haven't seen since the 1980s. Fortunately, the rate hike seemed to work. Inflation fell from a high of 9% in June of 2022 to around 3 to 4% today, and many people expect that inflation is going to continue to trend lower. So the Fed is happy with that, but it's still not satisfied. The central bank targets an inflation rate of 2%, and as long as inflation continues to run above that level, the Fed has said that it will keep its foot on the brakes. That said, just because the Fed has said it'll keep its foot on the brakes doesn't mean it's going to keep hiking rates indefinitely. In his most recent comments, Fed Chair Jerome Powell said that because of the progress that he and his colleagues have seen in bringing inflation down, the central bank probably doesn't have to increase the Fed funds rate much from here. It's already at a level that, according to Powell and the Fed, is restrictive enough to slow the economy and inflation over time. However, he also said that just because the Fed will eventually stop hiking rates doesn't mean it's going to suddenly turn around and start cutting rates. According to Powell, after the Fed makes its final rate hike, the central bank is going to keep rates at or near that peak level for as long as it takes to ensure that inflation comes down to 2% and stays there. Now, these comments from Powell weren't that surprising. Powell and other Fed officials have been saying similar things for a while. It's just that no one believed them. For much of the past year and a half, most people expected that once the Fed stopped hiking the federal funds rate, it would quickly reverse course and then start cutting rates. Their reasoning was that such a massive increase in interest rates would slow the economy dramatically, pushing it into a recession. But that recession never materialized, not even after the shocking collapse of Silicon Valley Bank and a handful of other regional banks earlier this year. In fact, rather than slowing down sharply, the US economy seems to be holding steady or even strengthening, which is a confounding outcome in the face of the Fed's massive interest rate hikes. So with no evidence of a recession, people started to throw in the towel on rate cuts and accept the Fed's view that rates would stay high for a while. A lot of people are calling this idea higher for longer. The federal funds rate is going to stay at a level that's higher than most people thought for longer than most people thought. This higher for longer narrative might be the reason that interest rates on the all-important 10-year Treasury, as well as other longer-term bonds, spiked in recent weeks. If the federal funds rate is going to stay above 5% over the next 12, 18 months, or whatever the case may be, then that's going to exert an upward gravitational pull on other longer-term interest rates as well. It's actually typical for long-term interest rates to be higher than short-term interest rates. So the fact that the interest rate on the 10-year Treasury has been below the federal funds rate for nearly a year is unusual. This phenomenon, when long-term interest rates are below short-term interest rates, is known as an inverted yield curve. And it's a reflection of economic concerns. People expect the economy to weaken and for the Federal Reserve to respond to that economic weakness with rate cuts. So the yield curve slopes down instead of up. But as I said earlier, because the economy has been so strong, the rate cut expectations are being thrown out, and consequently, the yield curve is normalizing. The interest rate on the 10-year Treasury today is still below the Fed funds rate, but the gap is narrowed significantly as people start to believe the higher for longer narrative. But that isn't the end of the story. Higher for longer is one explanation for the recent spike in long-term interest rates, and it almost certainly has played a part in those rate increases that we've seen. But there's a much more audacious view. Let's call it the view of the bond market bears. And it says that long-term interest rates are going up not just because of the Fed's commitment to keeping the federal funds rate high to stamp out the current bout of inflation, but for more structural reasons that'll reverberate for years to come. Under this view, factors like large government deficits, deglobalization, tight labor markets, and geopolitics will conspire to keep upward pressure on interest rates. For instance, the US government and many corporations have been pushing to bring manufacturing back to the US because of tensions with China and because they want to strengthen supply chain resiliency more generally. This trend, which is sometimes called deglobalization, could put upward pressure on prices because in many cases it's more expensive to manufacture things in this country. Meanwhile, the labor market has been tightening notably over the past couple of years, in part due to early retirements, mostly by baby boomers, and due to a drop in immigration and birth rates to their lowest levels in decades. A tighter labor market gives workers more power to demand higher wages, which then get passed on to consumers through higher product prices. So under the view of the bond market bears, deglobalization and tightness in the labor market will increase the long-term rate of inflation, which in turn will cause bond market investors to demand higher interest rates as compensation. Large government deficits are another thing that the bond market bears point to as a cause for higher interest rates. This year, the US federal government is expected to spend $1.5 trillion more than it takes in through taxes. In terms of dollars, that's the largest budget deficit outside of the pandemic years of 2020 and 2021. And even as a percentage of GDP, it's an extremely large 5.8%. The only other times in US history when there's been deficits of this magnitude is either during big recessions when tax revenues decline substantially or during world wars. The deficit has never been this large relative to the size of the economy outside of those crisis periods. The US federal budget deficit is expected to continue to increase over the coming decade, both on a nominal basis and as a percentage of GDP due to increased outlays to fund entitlement programs like Social Security and Medicare, as well as interest on the national debt. As the deficit grows, the government is going to have to borrow an increasing amount of money by selling treasury securities, which, according to the bond market bears, will only be purchased by investors if they come with higher interest rates. So if the bond market bears are right, we could be in for a radical shift in interest rates compared to what we experienced over the past decade and a half. You might recall that in the aftermath of the financial crisis in 2008, interest rates plunged to historically low levels and then stayed there for many, many years. The Fed kept the federal funds rate at zero for 7 straight years between 2008 and 2015. Central banks around the world, like the Bank of England and the European Central Bank, did the same, and in some cases took even more drastic action by cutting rates into negative territory. These ultra-low interest rate policies were a reaction to the dismal state of the economy following the global financial crisis. Following the GFC, economic growth was extremely weak, as households, banks, and other businesses worked to pay down their debt with the scars of the crisis still fresh in their minds. Consumers weren't spending and businesses weren't investing at nearly the rate they were prior to the crisis. Even the federal government became stingier about borrowing and spending money. This lack of growth and investment pushed interest rates down. But if the bond market bears are right, then that low interest rate paradigm that existed in the decade and a half following the global financial crisis has ended, and we're entering a new paradigm of higher interest rates. And not only that, if interest rates are going to be higher moving forward, then that means that the 40-year downtrend in interest rates that began in the 1980s is also over. So we're talking about what could potentially be a generational shift for interest rates. Over the past 40 years, all everyone has seen is interest rates going lower and lower and lower. That could be over, according to the bond market bears. With that said, that's just one side of the story. There are many who believe that nothing has fundamentally changed over the past couple of years and that interest rates will eventually come back down. The people in this camp don't believe that any of the factors I talked about earlier, deglobalization, tight labor markets, and large government deficits, are significant or different enough to cause a fundamental change in what interest rates should be, and that we're not in some type of new paradigm. So we'll see what happens. Time will tell whether the bond market bears or the bond market bulls are right about interest rates. But either way, it's worth thinking about what higher interest rates, if they are here to stay, could mean for the economy. In general, you can think of higher interest rates as a transfer of wealth from borrowers to lenders. If rates go up, lenders are better off. If rates go down, borrowers are better off. So now is a great time to be a lender. If you have savings, you can plop it in a money market fund and make 5% or more lending your money to the US government. You can make even more than that by offering riskier loans, for instance, to corporations. Now on the flip side, borrowers typically don't like higher interest rates. From a broad economic perspective, higher interest rates lead to less demand for borrowing money, which then translates into less consumption and investment. If you have to pay 9% instead of 6% on an auto loan, maybe you won't buy that car you've been eyeing. By the same token, if a company has to pay 8% instead of 3% to borrow money, maybe it's no longer profitable to build another factory. Some industries are obviously more affected than others. Real estate is very interest rate sensitive. We've seen the residential housing market essentially come to a standstill because of higher interest rates. Commercial real estate has been affected as well, and there's concerns that some commercial real estate operators could struggle to stay afloat if they're forced to refinance their debt at higher interest rates. Similar concerns exist for many companies that borrowed heavily during the low interest rate era and who have to refinance that debt at much higher interest rates in the future. And it's not just companies. The federal government is borrowing heavily to fund its budget deficit. And there's worries that as it issues new debt and rolls over its old debt at higher interest rates, its interest expenses will balloon. At some point, maybe the government's interest expense gets so high that it spooks bond investors, causing interest rates to rise further, leading to even higher expenses for the government, which causes more interest rate increases on in a vicious cycle. That's obviously a very gloomy scenario, and confidence in the government's finances will have to be shaken significantly before we ever see anything like that. But it's something to think about if interest rates stay high, or worse, head even higher. Another area where high interest rates have an impact is on asset prices. High interest rates make it so income received in the future is worth less today. So that weighs on the valuations of income generating assets, things like stocks and real estate. So by now you probably have a sense that high interest rates are a drag on the economy and asset prices when you look at them in isolation. But you gotta remember, the fluctuations that we're seeing in interest rates right now aren't happening in a vacuum. They're a reflection of several different factors, including expectations for Fed monetary policy, inflation, the federal budget deficit, and economic growth. You can think of these factors as impacting the supply and demand of bonds. If the supply of bonds increases, their price goes down and interest rates go up, since interest rates and bond prices move in opposite directions. On the other hand, if the demand for bonds increases, their price goes up and interest rates go down. So you can see the supply and demand for bonds drives interest rates. And today, the interplay between the supply and demand for bonds is driving interest rates up. That said, there's a difference between interest rates going up for good reasons and interest rates going up for bad reasons. A good reason would be economic growth is strong. In that scenario, companies and maybe even the government borrow a lot of money to fund capital investments. So they issue a lot of bonds, increasing the supply of bonds, and that pushes interest rates up. But they're happy to pay those higher rates because there's so many worthwhile, profitable investment opportunities in the economy. If you think about our current economy, maybe all of the money being spent on AI, clean energy, infrastructure, etc. is creating an investment boom that's driving interest rates higher. On the flip side, a bad reason for rates to go up would be concerns about the sustainability of the federal government's large budget deficits. If bond investors lose confidence in the federal government's fiscal discipline, that could spark that vicious cycle I talked about earlier. Then there's also inflation, which is a driver of interest rates as well. This one is kind of more neutral. It could be good or it could be bad. It really depends on whether the inflation is predictable or not. If long-term interest rates are going up because bond investors think that inflation is going to be a little bit higher going forward than it has been in the past, say 3% instead of 2% because of deglobalization and other factors, then that might be okay as long as the inflation is predictable and people know what to expect. Because I haven't mentioned this up until now, but it's important, it's the real inflation-adjusted interest rate that matters for the economy. If interest rates are 4% and inflation is 2%, then the real inflation-adjusted interest rate is 2%. You would have the same real interest rate in that scenario as when interest rates are 5% and inflation is 3%. In both cases, the real inflation-adjusted interest rate is 2%. So if the nominal interest rate, or the one that's not adjusted for inflation, goes up by 1 or 2% because investors expect expect inflation to be 1 or 2% higher, that's fine because then the nominal rate is only rising to reflect the higher rate of inflation. The real interest rate, which is the one that matters, isn't going up. Where you run into problems is if inflation becomes volatile and unpredictable. If prices rise 8% one year, 3% the next year, and then 5% the year after that, then things become a lot more uncertain. Investors don't know when inflation will be from one year to the next, and so they'll most likely demand much higher interest rates to compensate them for the higher risk of buying bonds. In that case, the real interest rate will probably go up quite a bit, which is bad for the economy. So high interest rates aren't a bad thing if they reflect better economic growth prospects or slightly higher inflation. They only start to become more of a concern if they're a reflection of unsustainable federal budget deficits, high and unpredictable levels of inflation, and things like that. So if the 10-year treasury yield settles around 5%, we probably don't need to panic. Assuming inflation is 2 or 3%, that translates into a real interest rate of 2 to 3%. Yes, that is much higher than what we saw over the past 15 years when real interest rates were between -1% and 1%, but it's not so different than what we saw before the global financial crisis. And if you go back and look, the economy and asset prices did pretty well in the 1990s and early 2000s, even with those higher interest rates. So I started this video by asking an important question. Are high interest rates here to stay? We're going to find out the answer to that in the coming months or even the coming years. But what might be an even more important question is this. If high interest rates are here to stay, is it for good reasons or bad reasons? Time will tell. I hope you enjoyed this video. If you want to see more videos like this focused on the economy, investing, and business, be sure to subscribe to my channel. Have a great day and see you next time.